everyone's in the prediction market right now because it's 2025 at the beginning, and we're thinking, okay, what's going to happen this year? And so we're going to all the experts, we're going to all the economists and asking the question, what's going to happen this year? And what I find kind of interesting is whenever I ask that question over decades that I've worked in real estate, the answer is usually pretty much the same as last year, but maybe a little bit different. And and that answer has become less and less satisfying for me as I've discovered that quite often, even in normal times, it's rare that everything is pretty much the same as it was last year, but just a little bit different.
You are listening to the AFIRE podcast: real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
So with that in mind, I'm asking today on the podcast someone who can actually say something that is not the same answer of the same as last year, but a little bit different, but help us see where the surprises might be. I am speaking today, of course, with Brian Klinksiek, who's the Global Head of Research and Strategy at LaSalle, a board member at AFIRE, and a frequent contributor to the thought leadership and the discussion around what is happening now and what is going to happen next. So thank you, Brian, for joining me on the AFIRE podcast.
Gunnar, thanks for having me.
So help me out here. How should I be looking at investing in 2025 and what might surprise us?
Well, the theme of our annual outlook is the dawn of a new real estate cycle. And we're sticking to that even with what's happened to long interest rates in the last couple months. There's so much other stuff that's aligned to still make it seem as if we're very likely turning a page. Mm-hmm. We've got prices more in line with where bond markets are, even though their rates are a little higher than they were in September when we settled on that theme. You've got valuations that have caught up with prices. You have the denominator effect that's resolved. You've got property market fundamentals, improving for the beat up sectors, and for the kind of out of favor sectors are coming back into investability. You have attractive price per pound. The supply hit sectors like U.S. apartments, global logistics, great sectors on demand, been really hard hit by supply lately. That supply pipeline is shutting off because the economics of development in many cases don't work. So that's just another way of saying that rents need to rise to justify development. So all of those are reasons why we're sticking to the notion that it's the dawn of a new real estate cycle. So all of our themes around this idea of mourning, and one of them we call the breakfast menu. We call it the breakfast menu because it's a big, complex breakfast menu. My colleague Rich Kleinman likes to say it's like a New York diner. There's a lot of things on the menu, but you don't want all of them. Some of them are pretty dodgy. But it's more complex than it was for the last couple of years because you have these sectors coming back into investability. You have a lot of variation within sectors. Some supply hit multifamily markets and some that are not so impacted. My parents, when they go to a place with a big menu, they open the big menu and stare at it for 20 minutes and read everything and hem and haw. And they order the same darn thing they always order off the menu. And that's what investors were doing for the last couple of years. Just more logistics and living, more sheds and beds. Mm-hmm. So they liked sectors that rhymed or were alliterative in their naming. But if you look at the history of ranking of performance, this period of time that we've been in where kind of ordering the usual for breakfast has been a winning strategy is not normal. Mm-hmm. In a normal period, markets are more dynamic and pricing moves around more dynamically, and so do fundamental prospects. And the sector that's on top kind of varies between year to year. So it's like 7 years in a row of logistics being on top is not normal. We had the first year, last year in the US for 7 years, that it wasn't logistics, it was retail.
Right.
So we still like logistics and residential. We spend a lot of time on them. But the menu's gotten bigger, and it's not normal in financial markets for like one strategy to work forever. It's just worked for a really long time, ordering the usual sheds and beds. And I was trying to come up with something that was equally alliterative or rhyming about some of the other options. I couldn't make it work in English, so I thought, I don't speak French, so you got to bear with me here. But it's like, is it boutique and bureau? Shops and offices. Look, it's a different story for both of those sectors, and maybe it's not the best two to mention here, but we've got a big menu in front of us going into 2025.
And certainly it seems to me that it's time for a palate cleanser, and perhaps you're right. Maybe it is boutiques and bureaus as a different sort of strategy that may be winning. But help me understand that, because certainly, everyone talks about office as being a danger zone unless you have the best of the best. And everyone talks about retail as in, gee, I mean, I'm still in shock from what happened during the great financial crisis. So help me understand that.
Yeah, so offices are at the beginning of their recovery in the US. You mentioned earlier forecasting and how often your forecast can be just taking last year and changing it a little bit. That is actually turns out to be a pretty good way of forecasting, just on a technical basis. Another good way of forecasting is just finding historical relationships between different variables. So in offices, the most classic historical relationship was between office using job creation and occupied square footage. And that relationship totally broke down with COVID. And what we see now is the beginning of it starting to reassert itself. So the link between those two is coming back. And what that implies is that the post-COVID space per worker adjustment, the hybrid work impact, absent any forecast of whether hybrid work is going to continue on its gradual decrease, is starting to reassert itself. And that means that a lot of that impact on demand has happened. So we still have a mountain of vacancy. So if the demand is coming back and how that adjustment has happened to a larger extent, you have to start eating away into the mound of vacancy. And our expectation is that that will start happening in 2025. Mm-hmm. And a lot of people love talking about conversions or demolitions. But when we look back at past periods of oversupply, the biggest driver of eating away at a mountain of vacancy is just time. Time heals all wounds. It's going to take a period of very low supply. Net supply will be a little lower than gross because you will have a few of those conversions or demolitions, but right. It'll mostly just be gradual eating away at it. Now, you mentioned quality, and you wanted me to talk about some surprise predictions. It is completely unquestioned in the narrative out there that quality trumps the day. Clearly, on demand metrics, it does. But does that mean it trumps the day on investment prospects, the absolute top quality? And as investors, we can't just look at demand. We have to look at pricing. How is it being priced? That everyone focuses on offices being all about work from home, but it's also about the pricing or the insufficient pricing historically of CapEx. That offices were priced as if they were perfect. You had a fully let building with a great lobby, and everything was new and shiny, so it was perfect forever. Not recognizing these very clear, extended, multi-decade operating history of offices is that they're super capital intensive. Mm-hmm. And I fear that the narrative about the very tippity top office buildings will lead to that part of the market continuing to be priced perfection. So we're spending a little time looking at gradations of quality that are towards the top of the spectrum, and not looking at the stuff that's got to be repurposed or fall out of the inventory or just become irrelevant, but recognizing that pricing and how those quality gradations really do impact whether it's a good risk-adjusted investment or not.
Interesting. So I get the sense then that office may, and this I've heard from others as well recently, that office may surprise us in 2025. Is that an accurate summarization?
I think so.
Interesting. So, all right. Well, what about data centers? Everyone's been talking about data centers. That's where everyone wants to invest. That's the hot spot. Is that going to continue unabated as far as you can see?
The demand for data centers is clearly very strong. The mm-hmm. supply for data centers is clearly insufficient to meet the demand. Mm-hmm. Those really aren't debatable points. I think the challenge comes in to where the scarcity, the source of that scarcity. Normally, in almost all the real estate, basically all the real estate sectors we look at, other than data centers, the scarcity comes from the availability of land and the mechanism to provide occupiable space, square footage, on top of that land. The constraint on data centers is all about power. So it's a different driver of scarcity. It's harder for real estate people to underwrite, I'd say, because the supply and demand of power is driven by technology. What is the technology around the production of power? the distribution of that power in the grid, and then how much power does it take to run a certain level of compute. I mean, data center investors love to remind us that, which is true, that we measure data centers in megawatts, but the users don't care about megawatts. The users care about compute. So next generations of chips could also use less power for a given amount of compute. So I guess what I'm saying is we have to be careful about the long-term growth expectations. This doesn't mean that data centers will suddenly not be performing strongly in the near term. But there are things that are hard to underwrite except for serious technologists that shape the supply and demand for data centers. 10 to 13% growth in sort of net income from an asset, which is kind of the run rate today. If you project that out forever, it doesn't take too many years of compounding for us to have an economy entirely dedicated to the payment of data center rents, which obviously is not going to be the case. For something trees don't grow to the sky. You can't have it exceed inflation and nominal GDP forever. It can do that for extended periods of time. But at some point, I think there will be innovations. Every time there's a tremendous economic incentive to innovate, we've innovated. Now, certainly there are maybe problems that are unsolvable with technology. And we've been surprised as a human civilization, generation after generation, of whenever there's an incentive, especially economically, to solve a problem, it gets solved. And I think that this constraint on data centers does get solved at some point. And once that starts to be priced in, it doesn't mean it's a bad sector, but it won't be on the same trajectory.
But it's not a no-brainer. It seems to me that we have a very steep learning curve around data centers that all of us, even those that don't invest in data centers, need to understand in terms of understanding energy and energy supply, understanding technology and its demand. I think your point is well taken, that as real estate investors, we need to learn how to underwrite that. And that is something that maybe we're still in the 101 class on that, and we need to step it up. Certainly, even in 2025, as it continues to perform really well. But I think good advice. Let's be careful around that.
100%.
Well, thank you, Brian. We've been speaking with Brian Klinksiek, who's the global head of research and strategy at LaSalle Investment Management. And we're very excited about what's going to happen in 2025 and all the surprises we haven't talked about. And I'm sure there will be plenty, given all the change that's occurring right now, politically, socially, technologically, and economically around the world. So thank you, Brian, for spending some time with us on the AFIRE podcast.
Thanks, Gunnar.
You've been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.